How DeFi protocols generate revenue and why it's important. In decentralized finance, revenue drives everything. From attracting liquidity to enhancing yields, a protocol's financial fortunes directly impact the prosperity of its users. Yet deciphering the often complex revenue streams powering this burgeoning sector remains an enigma for many. In this presentation, we aim to shine light on how DeFi protocols generate value and why it matters. Through straightforward examples like lending, exchanges, and yield farming, we'll explore the revenue engines at the core of this multi-billion-dollar ecosystem. More importantly, we'll uncover exactly how returns are shared with stakeholders to align incentives. By shedding light on these hidden mechanics, our goal is twofold: to comprehend DeFi protocols in their purest form, as well as make more informed investment choices. Decentralized finance, DeFi, protocols offer decentralized financial services via smart contracts and charge fees for those services. When a DeFi project's revenue increases, it attracts more users and liquidity. Choosing between different DeFi protocols can take plenty of time and effort. Many seem similar, so how do we know which one is the best for generating passive income from our crypto? An essential step is understanding a platform's revenue and how much of it is shared with its users. You can then use this information to make an informed decision on where to invest your assets. So whether new to DeFi or a seasoned vet, let's work to grasp the revenue principles driving this revolution together. Our journey begins with the question: where does the money truly come from in decentralized finance? How DeFi protocols function. Decentralized finance, DeFi, protocols offer a range of financial services that operate via smart contracts. For example, a DeFi protocol could offer decentralized exchange services, loans, and liquidity pools, all run via smart contracts on a blockchain. All you need to access and use these services is a wallet and some crypto to cover your transaction fees. There's almost no limit to the financial services DeFi can offer. You can access exchange services, money markets, derivatives, and savings products in the DeFi world. All of these services are permissionless and disintermediated in nature. How DeFi protocols generate revenue. DeFi services operating costs come from the computing power needed to run smart contracts. Users typically cover this amount with the gas fees they pay. However, there are also other additional costs for services such as development and maintenance. DeFi protocols charge fees for their services to cover these costs and generate a profit. Decentralized exchanges, DEXs. User swapping tokens on a DEX must pay a fee to utilize its services. For example, a trade may incur a 0.3% fee for the DEX operator's treasury or liquidity reserves. Lending protocols. Users who borrow from a lending protocol must pay a borrowing fee. Some of this will go to paying the liquidity provider, other users who have provided capital, while the rest will go to the protocol. Why revenue is important. Beyond covering a protocol's costs, improved revenue and profits can also benefit stackers. DeFi projects often maintain a revenue-sharing model via their governance token holders. They also may use revenues to increase APRs for stackers or liquidity providers on their platforms. For DEXs, higher revenue can attract more users and in turn, improve liquidity. It can also boost APY for yield aggregators if they benefit from combining user-staked funds for bribes as network validators. To summarize, we can describe a project's inflows and revenues in a circular fashion. Popular projects attract liquidity, which attracts more users and forms a virtuous cycle. Higher trading traffic and liquidity lead to lower slippage and faster execution. More users improve legitimate trading volume, which leads to more revenue. Revenue is shared with staked users, which provides more liquidity. This loop also attracts users who want to engage in yield farming. Those looking to invest their money can increase their chances of maximizing their gains with compound interest. The more successful a project is, the more liquidity and, in turn, the more yield farmers it will attract. This process generates more revenue that can be used to improve a protocol's offering. How to see how much DeFi protocols generate. DeFi operates on-chain, which means almost all transactional information, depending on the blockchain used, is verifiable. Blockchain Explorer is easily accessible by everyone, but that doesn't mean we can always understand the extent of a protocol's revenue. There are a number of blockchain data aggregators that simplify the task so you can better understand each protocol's revenue. With a Google search and some research from trusted sources, you should be able to find metrics, revenues, and stats on DeFi protocols' revenues. These figures can help you make more informed investment decisions. Revenue is a crucial metric to study, whether you're looking at a project's real yield or basic fundamentals. You can wisely invest only if you understand how a protocol generates and shares its revenue. In conclusion, understanding a DeFi protocol's revenue model is pivotal for users seeking to optimize gains and projects aiming to thrive. The ability to attract greater liquidity through equitable revenue sharing directly impacts the sustainability and success of an automated, transparent financial system. While complexities remain as the industry matures, fundamental principles around incentivization, alignment of stakeholder interests, and generation of self-sustaining flywheels provide clear lessons. With due diligence, participants can forecast potential and pitfalls. Most importantly, may this discussion spark further exploration. For it is only by illuminating DeFi's inner workings that we progress comprehension and foster prudent involvement in its burgeoning landscape. My aim in presenting was to demystify DeFi's financial foundations and empower informed participation. This emerging paradigm shifts how value itself is created. May its study invite us all to pioneer the financial future together. The decentralized journey continues.